Hi, everyone. I'm Henry Pearson with eXp Realty. I'm with Bill Baker from Barrett Financial, and I wanted to invite Bill in today. Just finished a closing. Congratulations, Bill.
Thank you.
Yeah. Bill is a local lender within the Indianapolis marketplace. And so, as a realtor, Bill, I get questions from time to time based on the current interest rates. Is it a good time to buy? Because in 2024, we've seen the interest rates go up and down, up and down. And some buyers are a little scared to jump into the market to find their dream home. So what I wanted to discuss, what are the current interest rates based on the loan programs? Well, first, let me start off. As Barrett Financial, what loan programs do you offer, you know, first-time home buyers or buyers in general?
You bet. Well, thanks, first of all, Henry, for having me. And yes, I am one of the about 1,600 loan officers nationwide for Barrett Financial Group. We're both a mortgage broker and a correspondent lender, which isn't much of a distinction there, but we have a tremendous amount of loan programs. If you go up to a 5,000-foot view, the programs that we have are, of course, principally in what we call the broadest definition of conventional financing, which are government loans like FHA through the Federal Housing Administration, which is a department of HUD.
Right.
We have Department of VA loans, which are for veterans or active service members if they're qualified for that. The smallest group is rural development loans through the U.S. Department of Agriculture, and the largest, that is most of the loans that are done nationally in the conventional world, are what we call agency conventional loans. Those agencies being Fannie Mae and Freddie Mac.
Okay.
And not only does Barrett Financial offer all of those conventional type loans, we also can get out of that spectrum with jumbo loans, which get beyond the conforming limits. And then we have a whole host of lenders that work with us for what are called non-qualified mortgages, which get into different areas where people can't qualify in the normal route. Let's say there may be self-employed and there's profit and loss statement loans or bank statement loans. Or loans that are collateral-based loans that are specifically for investment properties.
Okay, no, that's good information, because being a realtor, everyone's buying situation is different. First-time home buyer. So let's start off with that. So we got a first-time home buyer. Well, what programs it's better gonna suit them?
Well, let's say that first-time home buyer programs are done, first-time home buyers, I should say, a large percentage of the time use FHA financing.
Correct.
One of the biggest misinformation pieces out there in the marketplace is that many people contact me and they ask about FHA financing feeling like it is only for first-time home buyers.
Right.
That it's one and done. They buy their first house with FHA and they can never use it again.
And that's not true.
Absolutely not the truth.
That's not true.
You can be your first house, it can be your 10th house.
Right.
What FHA is not in the business of is doing non-owner occupied. So the two main areas that have that are for first-time home buyers are FHA financing, again, which is not exclusively for first-time home buyers, and then agency conventional loans are not for first-time home buyers specifically, but they have programs for first-time home buyers that are very good if you qualify.
That's true. And so going down the FHA road, okay, what, and that's another question I get. What's the down payment requirements?
You bet. There is several attributes comparing, and let's start by saying that so you get a feel for the overall United States lending market. Take VA and USDA out of the picture, which are 12% in 2023 and 1% respectively of the loans nationwide. Agency conventional loans, aka Fannie Mae and Freddie Mac guidelines, are 70% of the loans that were done in the United States last year, with the second category being FHA, 17%. So you have 87% of the loans nationwide between just those two. And let's focus in on the differences between those. With FHA, We have, they are low down payment loans. It takes a 3.5% minimum down payment.
Okay.
And the main difference is you can pay more down payment. You can even, pay as much down payment as you want.
But you're only required for three and a half
You're
percent.
only required for 3.5%. The mortgage insurance that is applied is in two parts for FHA. There is an upfront charge,
Right.
which is 1.75% for all people, and
Okay.
it's typically financed into the loan.
Right.
This is an important distinction because when you put 3.5% down, but you pay therefore a 1.75% charge that's added into the loan, one of the disadvantages of FHA is that you're going in with less equity. You're really going in with 1.75% equity because of that charge.
Right.
Now, the benefit to FHA loans is that typically across all credit spectrums, they are lower rates and can be lower costs as well. Where I have found, and if you want to switch gears to conventional financing.
Well, that was going to be my next route because, what the questions I get, what's the difference between FHA? Is that a better program for me? Or if I go conventional, okay, one, do I have more buying power? Okay, do I have to put more of a down payment down? Which conventional, I think everybody knows that there is a higher down payment that you have to put down.
Mhm.
But based on what I qualify for, is that the best route that I should actually take? Okay.
Absolutely. And since those two loan types are 87%, as we mentioned, of the loans nationwide,
Right.
when I pre-approve a customer, and once I have all the data with regard to income, assets, credit profile, including credit scores,
Mm-hmm.
I'm always going to take a look, at least briefly, of both agency conventional and FHA options for that customer.
Okay.
99 times out of 100, one of them will clearly be the best to work with. Sometimes they'll be pretty close
Right.
because the down payments can actually be a little lower at 3% down for agency conventional if you qualify for the first time homebuyer programs. Whereas again, FHA, it doesn't matter how much money you make or whether you're a 10th time homebuyer, you're fine with that. But you do have to be a first time homebuyer and normally meet some income restrictions and a little education piece that you have to do as well in order to do that agency conventional. Otherwise, it only jumps to 5% down
Okay.
payment.
Okay. And I always thought, I always thought what I know is conventional, like I said, you got the three and a half for FHA.
Mhm.
Usually conventional, depending on your credit, it could be 5% and a little bit higher.
Mhm.
Everyone's situation is different.
Mhm.
Now, another question that I get quite often is, you know, I'm just starting out, okay? Um, we've saved our money. What are the credit requirements if I do go FHA compared to conventional? So to qualify for FHA, what does an applicant's credit score need to be, as
That's an
well as
excellent
conventional?
question. And
Right.
I can tell you that it depends. um, there is much more leniency in the underwriting guidelines overall with FHA.
Mm-hmm.
Specific to credit scores, the FHA will say that credit scores are okay to be down as low as 500. But if you're in the 500 to 579 range, it typically is going to require a 10% minimum down payment.
Okay.
Whereas from 580 up, it is the 3.5% standard FHA program.
Right.
It's also important, though, to point out that once your credit scores are in the 620 to 640 range, you have a whole lot more lenders and better pricing that would be available. Because even though the FHA says that credit scores can be as low as 500, doesn't mean that lenders will allow that. Because simply, even though FHA is a government loan, it is insured by the Department of the HUD.
Right.
They are not the lender. So the
Right.
lender still has choice in what their particular programs are, or as they're called, overlays. They may be a bit more restrictive than FHA guidelines.
Okay. And so here's another good question. So, FHA, conventional, VA, etc. Okay. So applicant is pre-approved.
Mhm.
Okay. And we all know there's a difference, between being pre-qualified and
Mhm.
pre-approved for a
Mhm.
mortgage. But they're pre-approved. They're going through the program.
Mhm.
We're trying to go through closing. We really want to get things going the correct way. Um, let's talk about rate lockdowns. How does that work?
Okay, absolutely. Um, it's pretty much the same for all loan types. Uh, when a purchase contract comes together, quite often there is 30 days or less before the
Right.
closing.
Okay.
And with the volatility in the market these days, typically locking the rate as soon as the application is complete, including the purchase contract is executed, is normally the best way to go. However, I discuss with all of my borrowers the option, if they want to be risk takers, or if we have some gut feeling or reason to believe based on market data that there's a better than 50% chance the rates might drop in the coming week or two.
Right.
I do give my customers the option to float the rate. You typically need to be rate locking, though, at least about 15 days out. So
Okay.
there's a narrow window of time.
So prior to up to closing, okay, is it possible that the rate could come unlocked? And what happens after they close? Okay. After they close, they close, they got the keys to the new house, they're ready to make their first payment, everything's going great. Can those rates change?
Well, no, not for a fixed rate loan, it would never change. The
Right.
purpose of a rate lock for both agency conventional and FHA, all loan types really, the purpose of the rate lock is it's like an insurance policy that doesn't cost you anything. In other words, me, the lender, or to the borrower, the rate lock doesn't have a specific cost. What you're doing is locking in the rate that as long as you close within the time period of the rate lock,
Mm-hmm.
and importantly, rate locks follow property addresses.
Right.
So if a customer locks a rate on a particular property
Right.
and that deal falls through, that rate lock cannot carry to the purchase of a different property.
Okay.
So with that though, the maximum the rate can be, in other words, it's a contractual obligation from the lender that if it closes in this amount of time, that's the most the rate can be. So your next question might be, and many customers ask, what happens if the rates drop after I rate lock?
Yeah.
Well,
What happens?
the short answer is you're expected to close on the locked rate to a degree. In other words, if what I have found with the lenders I work with, that if rates drop something nominal, let's say 1/4% or less, then in a sense, the cost of the insurance of the rate lock is to not let that noise worry you in the marketplace
Right.
and go ahead and close at the rate lock. Because remember, the rate lock is a contractual obligation that lenders go out and hedge in the financial markets to make sure that they deliver that rate lock. So you're protected if the rates go up, and then you have a little bit of protection if they come down. Here's how. When you start talking about a significant drop in rates, I'm going to define that as 3/8 or
Right.
more.
Right. Right. Right.
Then we open ourselves up, as long as we have a week or so before closing. The lenders typically will allow a renegotiation of that rate such that, let's say, a 3/8 drop, we might be able to bring the rate down normally by 1/4%. We can come down
Okay.
close to market.
And that's a good point. And I know there's so much information when you get into mortgage lending, approving, an applicant for their new home. And like I said, the interest rates have fluctuated throughout the year. I think right now we're at like between 6.6 to 6.9%. Okay. So as a lender, everyone always wants, the interest rates to go down because it gives them more buying power, right?
Mm-hmm.
Do we foresee uh, any more drop before the end of the year, or is that going to go back up in 2025? Are there any projections out there?
Well, I can say that the projections are that we're likely not going to see anything significant the balance of this calendar year. But again, um, even the experts that speculate on this, it is still a flip of the coin as
Okay,
far as
okay.
trying to predict
And that's
rates.
what I thought.
But
You
I
know,
think into
no,
next year, the general feeling is general interest rates will be dropping.
okay, that's great. So, I know you got a busy day ahead of you. So I want to thank you for spending time with me and answering a few mortgage related questions for buyers that are in the market. Ask everyone if this information was great for you. Please drop comments below. My information is on the channel. You can reach me at 317-445-5296. I'll also provide Bill's contact information if you would like to speak with him about getting pre-approved for a home. So thank you for tuning in, and we'll see you on the next time.